What's up, guys? In today's video, we're gonna talk about how much life insurance do you need, and do you need life insurance? So with that, let's just get right into the video. Okay, so in this video, I'm gonna go through 3 different ways which you can use to determine how much life insurance you need. And at the end of the video, I'll let you in on a little secret here, and I'll save it to the end. But there is an amount that you need, and it's very specific to each individual person. But there is 3 ways that you can determine how much life insurance you need. So the first way is incredibly basic. This is kind of a rule of thumb. It's a little bit of a standard, but it's 7 to 10 times your annual salary. So yeah, I mean, sometimes this works for some people, sometimes it doesn't. So if you make $50,000 a year, you know, $350 to $500,000 is the general rule of thumb. Obviously, this doesn't take into consideration a mortgage you might have, how many children you have, if you're married, if you have a spouse. It obviously doesn't take into consideration how old you are, how long you need the life insurance for. So it's definitely not the best form of a needs analysis to do, but it's a general rule of thumb, 7 to 10 times your annual salary. The next one I'll talk about, and this is more of a standard in the insurance industry, is something known as the DIME formula. So DIME is just an acronym. It stands for debt, income, mortgage, and education. So D-I-M-E, debt, income, mortgage, and education. So debt, that's pretty straightforward. What outstanding debt do you have that you want to get settled if you were to pass away? That's straightforward. Income is an interesting one because it's specific to each individual person. So income is the amount of years that you would want to have your income paid to your beneficiaries if you did pass away. So if you're the breadwinner in your family, this is something that's very specific to you. If you are married and you have children and your children are quite young, let's say they're 1 to 5 years old, okay? And you're the primary breadwinner in your family, well, you would probably want to have that income given to your spouse if you did pass away for at least 15 to 20 years while your children are growing up and they're getting out of the house. And you want to make sure that if you did pass away, your spouse would be taken care of and that income would be replaced if you did pass away. However, on the flip side, if you're, let's say, in your 50s, your children are grown up now, maybe you're not the primary breadwinner in the family. In that case, maybe your income doesn't need to be replaced. So it's all on a case-by-case basis, and it's very specific to you. So what your income is and how many years your spouse would require that income for. Now, M stands for mortgage. So what is your outstanding mortgage on your home? It's a very nice thing to just have this taken care of, paid off. You no longer need to pay it. If you did pass away, have that outstanding mortgage just paid off. That's pretty straightforward. And the last one is E for children's education. So again, if you are younger and you do have children and you wanted to pay for their post-secondary education, which is quite common nowadays, you can allocate potentially $5,000 to $10,000, depending on what school they want to go to, per year, per child, if you did pass away. So that could be anywhere from $20,000 to $30,000 per child. It's just a little added extra amount to put in there just for your children if they did want to go to a post-secondary education and you did want to pay for it. Obviously, that number can be 0, but it is included in there. Now, once you take this DIME formula and you add all of those up, one of the things that you want to do is you want to subtract savings and current life insurance from this. So that's really important because we don't necessarily want to be overpaying for life insurance and be paying for life insurance that we might not necessarily need. So again, this is specific to each individual person, but self-insurance is one of the things that you can do. So if you had a need for, let's say, $400,000 to $450,000 of life insurance, but you had savings of $600,000, while yes, term insurance is relatively inexpensive, you could argue that you can self-insure and you don't necessarily need the life insurance, okay? And of course, if you did have other forms of life insurance, such as group life insurance or other policies, well, then that would subtract from what you already need. So if you had a policy from your work for $250,000 and you had a need for $500,000, well, you're only gonna need another $250,000. That's pretty straightforward. So that is the DIME formula. It's a relatively easy formula to figure out how much you need. If you wanted to, I will show you. We can go real quick over here. So Affinity Life is just an online life insurance marketplace. You can actually view quotes online and you can apply 100% online as well. But I want to show you guys the needs analysis. So you just go there to get a quote and then you go looking for a recommendation. You answer this question, no, let's say, and then this is basically going to be the dime formula with a few other details put in there as well. So let's say, do you have a spouse or partner? Yes, we do. No, we don't have any children. Our annual income is $60,000. Our wife would need this for 10 years. We rent, no other debts. We do have some life insurance. Let's say that we have $200,000 through our work, our date of birth, gender, do we smoke or not? And here we go. So you can see it gives us an estimation of how much we would need, and that's based upon the dime formula. So 415,000. So our wife needed the income of 60,000 for 10 years, which would be 600,000. And then of course we had $200,000 of existing life insurance. So we subtracted that from our number. And now you're probably wondering what this $15,000 is right here extra. That's just essentially the final burial cost, because having a funeral does cost a little bit of money. And we just add that in there just as a little bit of buffer for funeral costs and burial costs and other things. And there you go, 415,000. We recommend a term 30. And then you can actually just see the prices for this product by just clicking this see price button. And you can see products across Canada from a few different companies, so IA, RBC, and CPP. And if you wanted to change the numbers, that's very easily doable. You could look at a 10-year term, a 20-year term, and of course you could change this up to 5 million to see what the different prices would be. Now, I mentioned at the beginning of this video, I would talk about, do you need life insurance, and not necessarily just how much you need. So do you need life insurance is a little bit of a complicated question to try and put in there, but there's some questions you can ask yourself. The biggest factor of needing life insurance is having people that rely upon you. So if you have family members that rely on you, such as a spouse and children, and then even if you have parents that rely on you as well. So that's a big one. If parents are financially relying upon you and your income to take care of them in their retirement, then the need for life insurance is definitely there. So you want to ask yourself some of those questions. If I passed away tomorrow, would the people around me that I care about be financially impacted? Okay. And now I also mentioned at the beginning of this video that I would tell you the secret formula for how much you need. Okay. And this is what it is. And this is what I find time and time again with all my clients. How much life insurance do you need? It's how much you can afford. Okay, so if you do this formula and you come up with, let's say, a need of 1 million or 1.5 million, and you look at the prices for life insurance and you say, Philip, I just can't afford that. That's more than my budget. I can afford maybe only $750,000 of face amount. Well, then that's how much you need. If you can only afford $750,000, that's better than nothing. At the end of the day, yeah, it would be great to get as much as you can and what you need, but if you can't, having something is better than nothing. So if you do all these formulas and equations and you come up with a number and you look at the price and you can't afford it, get something that you can afford and you can comfortably pay for each month, knowing that your loved ones will be protected. So with that, I hope you guys are enjoying this video. If you guys are enjoying this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next video.